go. This feels super on point. Yeah, good morning, everyone. Thank you for making the time to join the call, and thank you, Purdy and Em, for putting this together. I can see some familiar faces on the Zoom, which is quite cool to see. Some of you I've spoken with before, some of you I've connected with on LinkedIn, etc. So yeah, delighted to actually finally get on a call and hopefully share some valuable information. My name's Sam Marchant. I'm one of the investment team here at a firm called Hambro Perks. We've been around since kind of 2016, investing in everything from kind of early stage all the way up to growth through 12 different funds that we now have. So we can do anything from kind of primary equity investing to secondaries, venture debt, growth capital, you name it, special opportunities, you name it, we can do it. We love finding kind of assets and founders that are maybe not in those hype rounds, not known to the market, and the ones that we can get into and that we can support. I have the pleasure of sitting in the early stage funds, so the fund that we call the Leaders Fund. This fund, we invest anywhere from kind of 300 or 500k to about £3 million from in everything from pre-seed up to Series A. There are 4 key verticals that we really like, where we think the UK can kind of excel and build exceptional businesses in these verticals. Those are fintech, insurtech, digital health, sustainability, and then what we call kind of future of work and productivity, which, just being honest, at the moment basically means AI. So everything in that space. We typically like to lead rounds more than we kind of follow on. We're happy to syndicate, happy to go down on record saying this. There are funds that we like working with. There are also funds that we don't like working with. There are funds that out there that we feel cheat founders and put founders in a bad position, and we're not about that. So there are funds that we have on a blacklist that we don't work with. The reason we like to lead rounds is because we like to be as engaged as we possibly can be, but also just because we have kind of exceptional resource in-house, so in-house legal, portfolio support, etc. So it puts us in a good position there. My journey into VC was pretty weird, actually. So I read sports science, right? So I never read anything finance, business, nothing like that. I grew up watching my dad build software businesses, so kind of I guess experienced that firsthand. And then when I was at uni, I got kind of bored with the amount of spare time that I had, launched an FMCG business. And I ultimately kind of grew that business out of uni. Did that for 6 years, ended up having a good outcome with that. But towards the end, I started angel investing. And the angel investing led me to get connected to a wide number of different funds here in the UK. So I joined a firm called Ascension Ventures first. I'd done a few deals with them, knew the team there pretty well, and they said, look, this would be a fun spot for you to come and join. So ended up joining them in 2021. Saw the kind of hype cycle, saw everything go crazy. Thought that's what it's like, and then obviously kind of have been through the crash in terms of late 22, 23, and now obviously seeing things pick up in 2024. I joined Hambro Perks in 2022, at the end of 2022, because to be honest, I just wanted a different investing experience. HP is backed by some of the largest pension funds, sovereign wealth funds in the world, so it felt like a good place to kind of come and refine my craft. So that's me. I definitely spend more time with founders and hanging around founders. I would definitely put myself in the founder category above being an investor. I think too many investors don't realize actually how hard it is to sit on the other side of the table. And again, happy to go on record with this because there are too many investment bankers, consultants in this space, and actually being a founder kind of coming in, I think hopefully gives me a unique perspective, but above all else, it just gives me a sense of empathy. I've been there, I know what it's like, I know how hard it is. So hats off to all of you for being brave enough to go after it and do it. Hopefully that's a good intro though, Em.
Solid intro. For those of you who are not already following Sam on LinkedIn, definitely do so. He has like a massive following and pushes out a lot of content that we've kind of used to like shape the questions that we have for you, Sam. So if anyone wants to hear like more follow-up from today, check it out there. We'll link it afterwards. So I want to talk a little bit about how you are first assessing founders. So like, before we get into cold outreach, actually, what are the traits that you're looking for in a founder? And then how much of that are you actually looking for in that first meeting?
Yeah, it's a good question, because again, I've spoken about this quite a lot, I think, in terms of, when you approach a VC or an investor, how you set it up, the types of calls that they want to go and have. And I know that every individual investor is unique. So actually, I realize that often I talk about an approach that I like to see, which is quite biased and quite wrong. And I don't think it's necessarily exactly the winning approach and the winning formula, but I do think it works for anyone who is slightly more entrepreneurial and sits on the VC side, which actually, if you look at most of the American funds and the high performing funds, they tend to be, right. So I think I take that lens and that angle to it. For me, and from my perspective, a first call is literally just about understanding the individual who's on the other side of in this case, the other side of the laptop. It's about understanding what makes them tick. How do they get to this point? What's their kind of unique skill set, experience, edge? What makes them kind of truly exceptional and special? And I think I talk about it in a wide range of different things, everything from, grit, self-awareness, sector expertise, an ability to attract talent, natural leader, but doesn't want to be a leader, has an energy for solving a problem in a way that makes you think, okay, yeah, I'd follow this person till the very end. But all of these things kind of come up, and actually it's more of a gut feel, which I know is horrible to tell founders, but we as a team come off of founder meetings and you just go, yeah, you just know that person is not only incredibly switched on, they're switched on about their vertical, but the way they're approaching the business as well is really, really well defined and really well structured. I think in those first meetings, the key thing for me to try and understand is I really like founders who have a good sense of kind of commercial scalability to them. So, what have you done to actually generate money for this, whether it be for this business, whether it prior business, whether it be, okay, I came out of an investment bank or a consultancy, but I did that because I was making this amount of money on the side, or I was doing something, something that's entrepreneurial and something that's that ultimately is just scrappy. You took limited resources, put something together and created an outcome with it. That's a big thing for us. The second thing I would say is that we want founders who have a really unique perspective on a market and an opportunity. I meet a lot of people who are doing kind of incremental gains or incremental variations to either an existing product or trying to solve a problem that doesn't really actually matter. People don't really care about. So we want people who can totally think really, really differently, and kind of have a vision for the future or a vision for a solution that, is something that for most people, even some of the customers, they maybe can't even comprehend. We think that there are three different types of problems, and actually they're kind of the last one in that visionary bucket. That's where you can deliver really outsized returns, because you're basically taking customer behavior and changing it in a way that adds huge amounts of value to them. So sorry, long-winded answer to a very simple question, which is that actually, on that first call, I like to just really understand a founder, where they come from, who they are, what makes them tick, and then get into the business normally on a second call, because especially if you're talking at pre-seed and seed, everything else is going to change. It doesn't really matter what's in front of you right now. It's about, the founder and then their understanding of the problem.
So for a founder who's going in to, let's say, like a 30-minute meeting, either with yourself, although you sound like there's a specific way that you structure that first call to get a feel for the founder. But let's say it's either with yourself or like with an angel investor, and the founder's thinking, okay, I'm going to run through like 13 slides on my deck and then probably answer some questions about, business model and things like that in traction. What are other subtle things that they can do to actually, I guess, make it about themselves, or like show how they exemplify those traits that you said, while still covering those like traditional parts that an investor would expect to see?
Yeah, for sure. So I mean, everything. So again, I assume a number of things that I don't think most investors do, which is like they come to the call having read the deck, right? You'd be amazed at how many people are like, seriously, you haven't read the fucking deck? Like, the founders put this anyway. So I think I think there's a base level of respect that I'm assuming here that probably isn't always kind of prevalent. So just take this with a pinch of salt. if you're going into that first meeting and they've read a deck, they have all the information that they need on kind of current business model, or at least how you're thinking about these things. The first piece of the call is about you and your experience. Tell a story, take an investor along a journey, right? You started in an industry, something compelled you to move on in this space, or something compelled you to specialize. I went further down this route. I noticed X, Y, and Z opportunities. Again, I pursued them further. I refined my craft. I've become a sector expert or specialist in this specific space. And I noticed this problem area that came up. At that point, it's transitioning into the second phase that I like to call, we spend a lot of time assessing product market fit, or at least how founders think about product market fit in these kind of very early calls. So I think at this point, it's about demonstrating your understanding of how a customer experiences a problem. Problems are perceived in a wide range of different ways, but often, founders skip over actually going and speaking to customers and kind of validating their ideas. It sounds stupid, but trust me, the number of people I meet who say, yeah, I experienced this problem, I know a couple of other people did, and then boom, that's it. It's, I'm on to the next one. Or no, I'm on to just going away and building this. What's important is about having a kind of clear, demonstrable process for how you validated that a problem exists, the type of problem it is, and that actually it is worth going after and worth solving. How you solve it, the how is always, you're going to come at it from a number of different ways, and those things will change over time. But knowing that the problem exists and knowing that it's a pain that people are willing to pay for and that they will want to address, that's incredibly important. So those are the kind of, I guess, the two key things that want to land. And by the way, 30-minute call is never a 30-minute call. Investors are lazy people, late, whatever. You have all these intros, the big spiel about the fund. You're down to 20 minutes immediately, right? I often encourage founders not to run through a deck. Just focus on 4 key things. So, why now? Sorry, not in this order. Why this problem? Why this solution? Why you, and why now? Those are the 4 key things that you need to get across, right? The why you and the why now are probably the most important, and then the problem followed by the solution, because we all know that the solution is gonna change. So yeah, try and get that onto 1 or 4 slides or whatever you do, but that needs to be kind of really clear and really concise, because when you're flicking through decks, it just, investors get distracted and it's all over the place. And also the last thing I'll say on this is approach it like a conversation. If you can meet an investor in person, do it. It's something that at HP we spend a lot of time getting founders in, having kind of coffees, having meetings in person, because it changes the dynamic completely. You sit there, you look at a deck together, rather than someone controlling it on a screen, or you have specific questions that you kind of walk through, and it's just a much better experience, I think, for kind of getting points across.
Fantastic. One thing that I think is difficult for founders is like, when you're getting feedback from investors, let's say, you show the deck and they say, well, have you thought about this? Have you thought about that? And you want to show to the investor, like, yeah, I have thought about that. The reason we're not doing that is because of blah, blah, blah. But at the same time, it's so easy to kind of cross the line and just come across as like very aggressive, or make the investor, you kind of have to make the investor still feel like they have something to like add to your business, and that, you like their suggestions, even if you don't. What's a good way to seem both receptive to feedback, but also make it clear that like you have thought through, your strategy, and you're confident in your plan?
Oh yeah, this is a really difficult question, because my head is telling me one thing, my heart's telling me a different thing, right? So what my heart says here, right, is just say fuck it. Like, if the investor doesn't get it, there's another investor out there for you, right? There are enough funds, there's enough capital. Find someone who understands it and doesn't take the piss. Right, so that's that bit done. Now, the actual thing that is probably less of an emotional response to that question is saying, you have to take investors along a journey. Even when investors say, yeah, we're fintech experts, we've been investing in this space for years, they're not. They're probably ex-investment bankers or consultants who have done fintech investing for the last 2 to 3 years. They're still generalists, right? They don't know everything about payments. They don't know everything about, kind of fiat or crypto. Like, they're not experts. So you have to be able to take them on a journey and answer these questions. I think there's nothing more rude than an investor suggesting things to a founder. and that would do my absolute head in. So it's something that I definitely don't do unless a founder says, oh, what do you think about this? Have you researched this space? Because most investors are generalists. They don't know what they're doing. So, you've just got to understand that, they're coming from this perspective, and it's ridiculous to say this, but with a great sense of humility, just say, okay, I'm going to take you on this journey so that I can bring your learning up to speed. And this is why I understand this problem better than you, or this is why the solution that you're proposing or changes you're making, aren't going to work. The only caveat I have to that is if you're going into a conversation probably with a US fund where there's an entrepreneur who's turned to VC or investing, or an angel who's actually done what you're trying to do, then maybe it makes sense to listen. But for the most people, I wouldn't listen to that. But unfortunately, it's a game of sales, right? And you have to bring them on a journey and educate them in a way that you are. I'm also a big fan, if I flip this back to materials, for having a pitch deck, yes, but also having maybe like an FAQ or kind of product market fit customer assessment doc. So all of the interviews that you've had with potential customers, all of the questions that you've asked, all the responses that you've had, try and put them into one place, because ultimately you've gone from 0 to 100 in your understanding of this pain, this problem, this opportunity. An investor is maybe 20-30% of the way because of the deck that you've shared with them. But that gap, that's where most investors go, no, it's not for us. I just can't get my head around it. I'm just not going to do it, right? That's the gap where it's really critical to kind of provide them with enough, or provide us with enough materials, both verbally and kind of actually in document format, to kind of take them on the journey. So yeah, sorry, two responses to that question. I find it quite hard and ridiculous that investors would even suggest those kind of things. And there's nothing worse than in a feedback email, when I've met founders who've had this, feedback email that says, oh, we're not going to invest because of so-and-so reason, and we think that you should go and try this, this, and this. And it's like, well, if you think there's a big enough opportunity here, why would you not go and do it yourself? So yeah, I appreciate it. I appreciate it's difficult.
For one thing I remember at our last founders camp that you said was that you received something like a couple thousand decks per year, and I think you ended up investing in like 2 of them. One of them was a founder that you guys had previously backed. Which are obviously, we'll dive into more stuff about the statistics, but like just for us to focus on that deck and that initial outreach, what's something that like isn't even going to make the pile of stuff you're going to open? Like what's that initial hurdle that founders need to cross for you?
Yeah, it's so I said that stat, didn't I, at the founder day, and then
everyone got so depressed.
Yeah, so many people got really depressed. I was like, oh shit, I should have said it. But the reality is, we saw 5,100 decks, just over 5,100 decks last year. We did 4 new investments, 2 of which were in founders that we'd previously backed, so they were kind of known to the fund, and the other 2 were totally fresh, totally new investments for us. That was an anomaly, right? Like that is not a normal year for us. We want to be making 6 to 8 investments a year. That's kind of, as a seed fund, that's where we're trying to do. The volume of decks that we see, again, that's consistent to what we're seeing here. And now we're probably trending this year to maybe even break the 6,000 mark, just from where we are, kind of almost in the middle of the year. So yeah, the volume is high. In terms of actually kind of cutting through the noise, there was a tweet that went around recently of an investor being like, oh, if there's a spelling mistake, or if you miss this stuff off, or if you have a date wrong in the, that's bullshit. I mean, that's just lazy behavior, right? If you believe that great can come from anywhere, which is the game that we're in, you have to take the time to understand people. I won't show you because obviously there's loads of confidential information on there, but our CRM, we use Affinity to track all of our deals. We have company website decks, everything that's submitted, whether it's Typeform or we've inputted it, but the number 1 column, so you have company name, website, and the first kind of column after that is LinkedIn. So we go straight to a kind of founder's bio, and that's the thing that really drives the decision making. We will almost always look at a founder and say, okay, because even if it's outside of our 4 verticals, there still could be a massive opportunity for us to generate huge returns and to go on an incredible journey with the founder. So we make the time to actually go into it and understand who they are. So for me personally, and I know this is reflective of the entire kind of early stage team at HP, it would be making sure that, it sounds obvious, but making sure your LinkedIn is up to date, and that all the information there shows that you're a kind of sector expert. I mean, Purdy, you started at, I guess the call off by saying, people should follow on LinkedIn. It's been amazing for me personally, actually, the amount of learning and the connections that I've built on LinkedIn. So it is a tool, use it, start pushing stuff out about your vertical, your problem. You'll be amazed what actually happens to you. So yeah, I think in terms of standing out, for us, it's always about personal kind of background and showing, not only what you've done, but who you are and what makes you incredible. Yes, there is a lot of bias that comes in with that. We're not one of these funds that uses AI to kind of pull founders up. We do have a tool that surfaces founders and companies that would be a good fit for us. But there's no bias or weighting into specific unis or jobs or companies, anything like that. We actually think that a lot of people who can come out of the Googles, the Apples, the Amazons of this world are actually quite lazy. They're not scrappy. They haven't had to do a whole lot much. They haven't had to do a huge amount. So it's very, very different. So I think for me, it's always about founder profile and personal profile. And then the other thing I will say is that on that kind of level of volume, it is just you can't read every single deck, and you definitely can't read every deck that's kind of 20 or 30 pages long. So just make it really concise. When you're submitting a deck to an investor, whether it be a VC, an angel, whoever it is, the goal of that is not to get investment immediately. The goal is to get on a call or to have a meeting. So give them enough that means they'll sit down with you and actually kind of take it seriously. So again, I can default back to those 4 points. The why this problem, why the solution, why now, why you. Those are the key things that you want to address straight away.
I think you're the first person that said that you guys just immediately jump on LinkedIn. Mm-hmm. I'm sure more investors do, but we haven't heard it before. That's really, really useful. Founders, how many of you guys feel confident that your LinkedIn profile would demonstrate to a potential investor that you are an expert in your specific sector? I'm not seeing that many thumbs up. Okay, maybe that's a to-do list item for this week.
Yeah, I won't run a LinkedIn workshop. Let's not do that. But trust me, just start posting more. And look, the first product you make is probably going to be crap. The first post you do is probably going to be crap. Just get over it. Just do it. Right. Just put it out, and then it's going to refine from there. You're getting in your own way if you're not posting.
Yeah. What would you suggest for a founder who, for answering the why you question, maybe they don't have like a PhD and have been in that field for like 20 years. Let's say you're newer to the field, but you have this like fresh perspective, and you're really, really passionate about the problem. How can you share that? Or is that something that like does that not mean enough to it?
No. That's spot on, right? So for me, I look at it and I go, okay, I just want to know how this founder views this problem. Like, how have they spent enough time with potential customers? Have they spent enough time with people who actually feel the pain to know exactly what is required to kind of solve this? Is it something that is an immediate kind of painkiller solution? Is this something that, we have to wait for technology to get to a place where it can be solved? Is it a problem that actually is just so visionary, the solution, that the customer can't even comprehend it, and you have to take them on that really big kind of educational journey? It always comes back to, okay, is this founder, what's their kind of proximity to the customer, but also their relatability to the problem and their experience of the problem? And I'm not saying you have to have lived experience. I think there is it's quite a lazy way of investing. It's just saying, we want you to have experience of the problem. I don't think you need to do that. I think because some of the best entrepreneurs I've met don't give a shit about the problem that they're trying to solve, but they care about building a big business, right? And being high performing in that respect. And they see a huge opportunity to wedge a solution in and extract value, not only for a company, but create value for a customer. So I think it's important that you demonstrate that and get that across. And that can come in the form of customer interviews. Obviously, the highest form of validation you can get is traction, people actually paying and handing over money for this. But on the most part, it just literally comes back down to your level of understanding around the pain point, who experiences it, your current solutions, etc., etc. That's what, you know, as an investor perspective, that's what I'm trying to understand. Because ultimately what you're doing there is you're trying to hack the amount of time required for you as a founder to learn all of those things and figure that all out. That's all runway is, you know, especially at pre-seed and seed. We talk about it in terms of runway, and it's like, okay, how many times am I going to fuck up and test these things before actually I hit the right thing? And obviously, yeah, there's a velocity question there, and how quickly you can do that as a founder. But also there's a question of, okay, am I coming in cold, or actually, no, I'm at 0 to 50, 60 out of 100. That's the kind of question that we're trying to answer.
Makes sense. Founders, quick reminder, we'll move to Q&A shortly. So if you want to ask a question, raise your hand. I know we've had some questions coming in from the chat, which we'll get to as well. Okay, actually, before we go into the deck, speed of execution, can you talk a little bit about that? Like, one of the things that founders do in the programs is they submit weekly updates. And so on every single Friday, and we use that to determine who goes on to demo day, because it's like, it's not about where a founder is, it's like about how quickly they got there. But sometimes that gets lost in the traction slide, and it's difficult to demonstrate that. What are ways that you've seen that be effectively communicated?
Yeah, it's a good, again, I think it's something that founders often overlook, and it's little comments that kind of come up. So if you've got, so imagine you're a co-founding team, one of you is very commercial, one of you is very technical. So you're looking at the tech talent saying, okay, how quick can they ship product? How quickly can they ship MVP? How quickly can they ship iterations? Again, super tangible. You can see that. The biggest thing I find from the technical founder perspective is that people often get in their own way, and they want to write beautiful code and they want it to be absolutely perfect. Whereas, you know, just get something in someone's hands, start solving and bringing in a little bit of value, and you can iterate and you can build from there. So that's a very easy way of judging kind of speed of execution. From a commercial perspective, I think it's about actually not only number of kind of relationships that are maybe in a pipeline, but also how warm they are and what they say about you as a founder and the company itself. So, you know, again, it's not about slamming phones all day, but it's about having high quality conversations that are evolving. You know, you're bringing those individuals in on the process, as we've kind of already spoken about. And that actually you're then iterating and kind of building, and it's a kind of really strong team, you know, addressing that. I think it's easy for investors to just look at high level numbers and say, okay, yeah, we went from 0 to 50K of MRR in 9 months, right? Like, great, but actually, what was the foundation that needed to be laid before that? That's what's quite key. In terms of execution, kind of post investment, there are loads of little things. So, you know, people often say to me, yeah, we're going to hire these team members. And I say, okay, have you got candidates lined up? Like, do you know who you want to hire? No, we're going to run a process. Okay, well, if that process is going to take 2 months at best, and then you've got 2 to 3 month probation periods, you know, you're 5 months into the runway, and this is only going to last you 18 months. So we're down to almost a year, right? It's little things like this that impact a kind of startup and how much kind of velocity and speed it has. I also think that there's a lot of advice that's given around speed of execution in terms of investment rounds. You know, but again, I think the rounds that are really hyped are the ones that just kind of topple over. There was a company recently, I won't name them, but you know, they had 20 term sheets, and the raise had just gone absolutely mental, and that was in like a kind of 3-week period. By the time we had seen it, the founder was like, no, I'm not taking any more calls. You know, growth wasn't that interesting at all, but it was just the momentum factor of the founder kind of coming out, and they had a bit of a profile, but again, the performance of the business wasn't great, right? So, you know, don't buy into that and believe that you kind of have to have that. You'll find a good syndicate of investors for you as those kind of conversations progress. But yeah, and specifically for speed of execution, I think the key things are demonstrating the tangible, and making that really, really clear. And the slightly more intangible stuff, where it's, okay, yeah, we believe that this customer is going to come on board, or we know that we're having positive conversations. How much evidence can you get? And are you willing to put them in front of the investor as well? It's always a good litmus test.
Sense. Thanks. Okay, last little bit we'll focus on is the deck. How important is like just purely the aesthetic side of a deck? Do you care about that? Do you care if it's like just boring Microsoft slides in like, I don't know, Times New Roman, all white? Do you want a nicely designed Canva deck? What's your opinion?
Yeah, my opinion on, I don't know, my opinion on this changes quite a lot. Yeah, often I go, I just think it's ridiculous that, we expect, one thing, right, that I absolutely hate is that founders you should never pay for people to like build your decks for you and do all of this, right? Like, it's an absolute joke. Never ever pay to pitch, right? It's my job to come and find you. So don't ever pay to go along to those kind of events. In terms of like actually refining a deck and making it nice and clear and concise, if design tools help you, go for it. I've never turned a deck down, or I've never said, oh, I'm not going to have a founder call because someone sent me it on PowerPoint and it looks a bit, jaded. That's just ridiculous. I'm not sure I buy into that. Again, because everyone has their own way of kind of executing things and pushing things through. What I've noticed is that specific sectors and verticals have very kind of clear design patterns. We look at a lot of cybersecurity at the moment, and the decks are so boring. So like, they're deep PowerPoint, there's mad diagrams around them. I'm like, what the fuck does that even mean? I don't know, right? But these founders are exceptional. The traction is insane. The opportunity is great. So I kind of grind through them because I'm like, yeah, this is fine. On the flip side, you get these fintech decks and AI decks that are super well polished, and actually there's just no substance there whatsoever, and it's all a bit wishy-washy. So again, personal preference, I don't think it really matters. Will investors pull you up on it? Yeah, because they're just lazy, right? And it's an easy decision, and people go, oh, I can't, I can't get into this deck, I can't read it, it's not clear. So I think find the right balance. As I say, decks are a tool. Again, I don't want to create more and more work, but there's a first deck that just gets you the call. There's maybe a deck or a couple of slides that you're going to pitch on a call. There's then your data room and your information that you're going to share after the call, and you want to have all of that ready. Again, you'd be amazed the number of founders that I meet who go, and I'll say at the end of the call, even if I'm 50-50 on it, I'll go, yeah, look, can I have a look at the data room? I'd love to get some more information. I'd love to answer some of my own questions with the material, so I don't have to waste your time. The number of people, I would say genuinely 7, maybe even 8 out of 10 don't follow up with the data room, and that's it. And the relationship dies. Yeah. And that's, and then I get an email kind of 3-4 weeks down the line going, oh, hey, like, are you still interested? And it's like, you said you were going to share data with me, so like, I asked for the information. So look, I get it, it's busy, I know it's hard from a founder perspective to juggle all these things, but just have the information ready so you can just shoot it across straight away. It's the easiest way to go.
Crazy. I think with a deck, like if a founder is going to go for a, let's say, Microsoft PowerPoint, it's not going to be the most beautiful thing in the world. Like, just don't make it sloppy. I think that's like the one thing that kills it, is if it just doesn't seem like people pay attention to it, or like it just looks bad versus just like old fashioned,
Yeah.
It's a big difference.
100%. And
Go ahead.
No, I was just gonna say, and it also depends on the complexity of what you're building. We saw one of the ex-Revolut founding team recently kind of come out thinking about building something in the payment space. He didn't have a deck. He literally just had like a Loom video of the kind of problem, him kind of talking it through, and maybe people are more interested in him because of his background and what they've kind of done and his track record, and it's easier. But at the same time, that was the right way for him to pitch that product and that problem that he was kind of going after. Again, it's really tailored to your business. I mean, I think it's just about getting an investor's attention and making sure they actually read it and look at it, which is the hard part.
The video. Last, little question. Since you accept a very small percentage of founders, probably even into like a first call meeting too, how should founders view rejection? What advice do you have for them on that?
It's part of the process, right? There's so many, so many kind of companies out there, but also so many VC funds and pots of capital that you can access. It is just part of the process. I think what my advice is always never start pitching to your ideal investors first. Always speak to the people that you think, they're not going to be that ideal, but I can test my pitch on them. So by the way, if all of you now reach out to me being like, hey, do you want to have a chat? I know exactly what you're doing. Just to make that clear. So test your pitch first, and then the investors that you do really want to speak to, build the process with them. You can email them out first and say, hey, look, we're kind of coming out to a round, we're speaking to a few people, we know that you invest in our sector, we'd love to have a more detailed chat because we think that you'd be a really good fit for us. Changes the dynamic slightly, right? And then in terms of in terms of, I guess, kind of cutting through and actually how to run that process, it's very hard. I don't believe anymore that you have to have a warm intro. I think cold intros can work, or cold inbounds work. Again, it just becomes the information that you're sharing, and it needs to be relevant for that individual. So do your research. It's unfortunate that a lot of VCs don't put stuff out there and don't share exactly kind of what they think and how they want to operate, because I actually think they don't do that because most of them don't know, right? And they don't want to take a side of the fence. Whereas for me, I now seem to only speak to founders that are highly relevant for areas that I'm interested in, and people seem to pitch in a way that they know I like, which again, I'm very, very lucky that founders spend the time to do that, given that there's so much going on. But that's one of the powers of I guess posting more on LinkedIn, for example, whereby you feel like there's more of a relationship immediately. So the process is much, much better. Not sure if that answered the question, Em, but it's just something that I've noticed.
Okay, Harry, we're going to go to you first, and then Phil, and then we'll take the question from the chat.
Hi, Sam. How are you doing? Just reiterate what Em said. Your LinkedIn content is fantastic. Thank you.
Cheers,
just a quick question. I'd like to get your opinion on the state of the VC investing market at the moment. So I actually come from an institutional investment asset management background, and I came into VC from a fundraising perspective, I think a little bit optimistically. Every VC's got plastered all over the website. We back founders, we invest in ambitious teams, etc. We have found that not hugely to be the case. It's difficult to get meetings. We've had pre-seed funds telling us we're too early, which I was not aware was possible. And if I sort of put my cynical hat on, which I do have on my cynical hat, it feels like there's just a huge amount of risk aversion at the moment, and all VCs want is B2B SaaS companies that have already got 300 clients and they're about to take off. I'm not really feeling much. We back these people to change the world. Just interested to hear your sort of view on the risk appetite at the moment.
Right. Okay. Yeah. No, it's a great question, Harry. And I think I say right. Okay, because I'm like, this is being recorded, so I can't launch into a full spiel here. But happy to chat about this offline.
We can stop the recording.
No. It's fine. I'm not going to say anything. I'm not going to offend anyone. My view on this is maybe quite contrarian, given that I'm in this industry and I'm in this view. But I think this industry is going to have to change massively. Right. Let's take a step back. This is an asset class that now has exposure to capital from pension funds here in the UK, high exposure through the Mansion House Act, or Mansion House Pact. That will change the way that investors and underlying managers invest, not in a positive way, in my opinion, right? Coming from a founder perspective, the risk aversion will continue to increase. As the fund sizes increase, the returns expected also increases. And you look at the state of the market and you go, there are around 1,300 companies, private companies valued at over $1 billion. Where the fuck do they all go? How do you actually deliver underlying returns back to LPs, right? That's just not going to happen. And that's not an issue for founders, right? That's an issue for the managers who are allocating capital in this way, saying we demand these returns, and we've promised on this 100, 200, 300 million pound fund that we're going to get to X. And it forces us to try and build companies that don't really work, or in a worse case, it forces us to actually inflate valuations, and companies get so big that it's just the underlying qualities. It's just all bullshit. It's house of cards, right? I am incredibly bullish on venture studios and venture builders. And the reason for this is because if you think about the amount of equity you own and the entry price, and you go on a journey, if you could bring actual value to a startup, to a founder, you can have a 20, 50, 100 million pound exit, deliver good returns consistently, right, over and over again, because you're de-risking propositions. And that is a much better model than this traditional VC kind of spray and pray, which I think on the most part only really works in a US economy. So again, those are my really just unfiltered, very kind of out there views on this space. And, you know, obviously, Harry, no disrespect to your background for any of the investment banking or asset manager comments coming into VC, but, you know, most investors in the UK come from those backgrounds. They've never built startups. So hats off to you for going and jumping on the other side, right? And being in there and being in the fire. So they have absolutely no idea what risk is. You know, they don't know what's risky. They don't know what's not risky. They don't know whether to believe in a founder or not believe in a founder, right? And it's this herd mentality that goes round and round again. And what worries me is I think we're seeing this kind of, you know, associate to maybe even investment manager level looking up at partners and going, okay, I've learned from you and you're passing everything back down to me, and this ecosystem's not going to change. It's one of the biggest worries I have around creating a more diverse, you know, funding landscape. It's just I don't believe that that's going to happen while we have associates and IMs who are coming up saying, okay, our only view is from this partner who's been doing this for X number of years. So yeah, overall though, if I was a founder going out to fundraise this year, I would be optimistic about the amount of capital that there is to raise, or to raise from. But I would be very cautious about who I have conversations with and how I would kind of speak to, you know, whether I'd speak to funds, whether I'd speak to angels, whether I'd bootstrap, what would my plan look like? You know, would I even want to go for growth? You know, again, one of the questions I always ask in a first call is, okay, if I gave you a check for 20 million pounds right now, would you take it? And a number of founders go, yeah. And that's totally fine. That's an incredible life-changing amount of money, but this is a 100 million pound fund, right? We have to build billion-pound companies, whether that's stupid or not. You know, there we are. So yeah, sorry, Harry, that was more of a rant than an answer to your question. And sorry, everyone, I hope that hasn't put it down on it.
No, it's nice to hear someone speaking openly, and it's quite refreshing actually to hear. Thanks.
All right, Phil, you're up.
Great, thank you. Firstly, Sam, thanks for taking the time to chat with us. Also appreciate your LinkedIn post, amusing as well, which is nice.
Thanks.
Harry's question actually was a perfect setup for mine, which is we're super early, super pre-seed, bootstrapped. We've got proof of concept. We've got some users. And we've got a few investors sniffing around, angel investors, but I feel like I've got slightly stuck in an eddy, because it's exactly that situation where they're looking around and the feedback I'm getting is not just, oh, it's a bit early, but, oh, is there another investor going in? And it's this horrible situation where they're all waiting. Nobody wants to be the first guy in the pool, and they're all looking around at each other going, who's going to blink first? So how do you create FOMO when no one's going in and no one's diving? I mean, it's just, and we've only been doing this for a pretty short period of time, the investment side, but I feel like we're right at a tipping point where if someone would go in, they'd all follow, and I don't know what to do. That's a big question, by the way. Sorry.
No. It's a great question. I'm sure it's relevant to a number of people here. But and again, I'm going to ask an annoying question back, which is, do you know what's holding them back? Is it, okay, no one has put a valuation and no one wants to do a valuation on this? Is it because they, like, the individuals are going, look, I'm not an air sector expert in your space, so I don't know if I could do correct DD here? Is it they're saying, you know, we want a larger investor so you have access to follow-on capital? Like, I guess what's the...
Yeah, that's a great question. So there have been a few raised eyebrows about valuation, but, you know, I'm not going to die in a ditch about it. We've got a third-party company called Strivex to value us based on projected revenue and P&L, which is cool, and also market size, because, you know, 3 ways. And so I'm not going to die in a ditch about it. It's monopoly money right now. But what they're saying is exactly what they're saying to Harry, which is too early. Specifically, we'd like to see another lead investor and then we'll come on board. So I'm not really, you know, can you decode that? Does that mean actually they think the idea is shit, or they're literally looking for someone else to go in first?
Yeah, it looks like what they're, so there's again, so there's head and heart here. The underlying subconscious thing is that they want a lead investor to go in and validate it and say that this is good, so they don't have to do any of the work, right?
Right.
That would be my gut feel. In terms of what they're trying to say with that is that, you know, we want to see further validation, I guess, before we put the money in. I asked the question about terms and stuff because, you know, angels have a horrible trait of saying, oh, you know, we don't want to price things, we don't know, I don't want to value this, I don't want to do the DD. Okay. You just send me the terms and I'll wire the money. If that's the question, then I would do something like an ASA, make sure it's SEIS or EIS compliant, depending on how much you're raising. Because then ultimately you're just saying, okay, kind of pushing it down the road and you can get the capital in so you can kind of run with it and build. The it's too easy question for us is such bullshit, because as soon as you get traction, you're going to look at those investors and go, well, we don't need you.
Yeah.
So it's such a dumb question from an investor perspective. Like, you either believe in the opportunity or not. I would drill into them a little bit more and I would find out what would tip them over the edge from a traction or validation perspective. You know, is it signed contracts? Like, do you want to see 5, you know, LOIs or whatever it may be? Like, give it some real, I guess, core milestones, or kind of core goal or key goal, sorry, so that they're then almost like on the hook for it a little bit. Right. But if I was you, Phil, I'd be aware that, you know, even then it doesn't mean they're going to wire the money, right? No. You know, so it's difficult, but it might just give you some peace of mind as to, okay, what I'm building towards actually maybe has an outcome, whether that's positive or negative. And again, I would keep going. The other thing I would ask them is whether or not they know angel investors that they like to work with. Because what you'll find here is one individual introduces you to 2 more and they both are positive as well. It comes back onto that individual as to whether they're going to invest or not, because there's now 3 of you that want to do it, you know. So it's more of that kind of social, I guess, herd
so
mentality.
That de-risks it a bit for them.
Yeah, exactly. And that's how angels, because, you know, angels, it's not, they don't have to call up Phoenix and say, yeah, we've invested X amount of people's pensions into this company. It's their personal money, so it doesn't matter, they can do what they want with it, right?
Okay, yeah, that's interesting. So just try and get them in a very small way to make a short amount of commitment, even if it's not financial.
Yeah, exactly. Right. So, you know, okay, if it's a kind of KPI that they want to see that you can work towards, and it might not even be that you actually have to hit that KPI. It might just be they say, oh, Phil's done a great job of getting these, you know, building pipeline for these 5 LOIs, maybe, you know, yeah, okay, now I'm going to do it as a trigger. The other thing I would say to you is probably try and use something like an SPV provider. So, you know, a Carter or an Odin, you know, any of those kind of players. And the reason I say that is because they can just subscribe to that and it makes the whole process much easier. And you can also kind of play them off each other and say, well, the lead investor is doing it via an SPV, so you need to sign up, you know, and ultimately there is no lead investor, it's just that vehicle.
I did consider that, yeah, saying, oh, they're coming in, but they just need to see you. But I don't really want to, I don't want to get into this vicious circle of bullshitting everyone.
Yeah, whether that's sales or bullshit, I don't know. We could debate on that.
it's a fine line, yeah.
Exactly.
Right. That's super helpful, thank you, and actionable as well, which is always good.
That's a good question. I think a lot of other people will have as well. I'm going to take 3 questions from the chat. 2 of them are super quick, one of them slightly longer, and then Alessandra, I'll go to you. First question from Sandy. Are any of the funds from Hambro hardware friendly?
Not really. Well, I say not really because one of the partners is obsessed with hardware. He loves his latest thing is like drone on drone warfare. I think he's just a big kid, to be perfectly honest. He just loves it. So it's not that we're adverse to it. I think the thing is that we don't really have expertise in it. So we would have to kind of do quite a steep learning curve. But again, always happy to look at decks and see an opportunity, right?
Perfect. This question is from Purdy. Do you still angel invest alongside CapEx?
Yeah, it's a good question. I do, but I have to be very careful about how I do it. So basically, any opportunity that I want to invest in should come into Hambro Perks, right? If the rest of the team are like, no, don't want to do it, and this has happened a couple of times, I've said, cool, have I got clear reign to go away and invest? And they say, yeah, if you want to mess up your own money and do whatever, you know, fine. And then yeah, I can invest. Where it gets quite messy is in the follow-up round. You know, if I've I guess, picked well and done a good investment, then coming back to the fund and saying, hey, this company that I angel invested in is now raising, I think you should have a look. But as a team, we've done it with a number of deals. Every single person on the team is an angel investor in something that either the fund has gone on to back or has just raised from someone else. So yeah, so I do. But yeah, I had a bad bike crash over the weekend, so all of my money is now tied up in buying a new bike. So yeah.
So no one approached Sam for angel investment for a little bit.
Yeah, unless you're offering a bike with the kind of deal as well, then I'm down for it.
Next question from Alexandra. The main problem founders face, I think, is that we don't get to showcase all of these skills, the personality skills we're talking about, because it's hard to get the meetings in the first place. What advice do you have on getting those first meetings?
Yeah, again, in the first meeting, that I know that is the hardest part.
I already answered that, so if you just want to skip it, it's fine.
Have I? No. I think it's again, specifically focusing on it, I think it's always a question of like relevancy to the VC or the investor that you're trying to speak to, right? If you know that they're interested in something, whether it be their area of expertise or, you know, they published an article on something recently, the best tool for this is something called ShipShape. I don't know if any of you have used that. It's like a search engine tool. Look, I love it because it pulls from like, okay, this investor said XYZ on Twitter, so I can now craft a nice email out to them or a message on LinkedIn or Twitter that's more relevant. In terms of getting them on a meeting, I think it's just about making it easy. So, you know, giving them the materials that they need, setting everything up so that, you know, you're able to take that call and then understanding what the first call is and the outcome. So, but no, Alexandra, it's hard. I don't have like a silver bullet for it. I really don't. Yeah, I think whether it's cold outreach or warm, you know, if there's an investor that you really want to get to, just keep trying and try from a number of different angles, because eventually they will crack.
Perfect. Okay, Alessio, I know you've had a few questions in the chat, but I'll let you fire through them live, and we have like 3 minutes left.
Oh yeah, I will just go with the main one. Thank you, Sam, for all of these sessions. So I've been working in a fintech, and now I'm a solo founder of a prop tech company. I've been working in AI, and now with the properties, we started to tokenize residential properties here in London. We have the core business, that is the tokenization of residential properties, but to bring customers in, it will take more time than what normal products expect. Considering we have the AI underneath that we use, and I use personally my own AI to choose the properties, we decided to move this AI out and working with the state agency to use this AI. Would you say that the fact that now we have basically 2 products, do I need to have, there are the concerns because now there are 2 big products. There is one AI that is going to create revenues, and the tokenization side that will create revenues later?
It's a good question. So I think in the first instance, an investor is going to be looking at, okay, what's going to generate traction and revenue first, right? Which sounds like in this case, the AI. I don't know of any investors in my immediate network, and it's not an extensive network. I know a few people, right? But you know, I don't know anyone who is like huge and bullish on the tokenization and that kind of approach. I would advise that going down the AI route, if that product is landing with people and it generates revenue, go after it. Have the tokenization opportunity in the background, and that's a kind of auxiliary revenue stream. What you'll want to be careful of is actually how the businesses are valued. So we have a business in the portfolio that's doing incredibly well. Part of it is lending, part of it is B2B SaaS. We obviously want it to be valued on a B2B SaaS multiple because it's much better than a lending multiple, but the B2B SaaS revenue is actually lower than the lending. So I think it's about weighing up your options as to what's going to grow further. The other thing is you're a solo founder, so you can't split yourself in half, or to split yourself in half and the resource allocation is very difficult. I would look at the opportunities side by side, see where the validation and the traction is coming from. If you need capital further down the line, look at where that capital is going to come from. As I say, I think, you know, I don't know any investors looking at the kind of tokenization space at the moment, but again, that's just my bias and my network. And I would say, okay, which of these is more viable and what should I focus my time on, you know? And I would see the tokenization piece as not as a failure. I'd see it as a learning curve to get to the AI piece, right? Product's always going to pivot and grow. So I'd view it like that.
All right, we probably have to wrap it right there. Sam, thank you so much for joining us. Again, follow him on LinkedIn. We'll share the link afterwards and wave goodbye to Sam. Sam, actually, is the best